Have you ever heard a friend, family member, or a coworker talk about the fact that rich people avoid paying taxes? If so, did it make you think that they must be doing something illegal and they just get away with it because they're rich? Here's the big question. Do you want to get in on it? I'm Jason Kish. I'm in the commercial real estate investing space, and we're going to talk about how wealthy people minimize their tax bill legally and how you can do the same. I'll start off by saying that there are two primary ways that wealthy people reduce their tax bills: owning a business or owning real estate. The way to optimize tax efficiency through businesses can be pretty complicated and is highly tailored to each business. In this video, I'll focus on how owning real estate reduces your tax burden and how to access money from your real estate without it being taxed as income, and then how you can transfer that wealth to the next generation without the government taking a big bite out of it. The primary driver of tax savings in real estate is related to depreciation. Depreciation is a non-cash tax deduction that can offset rental income and even regular income if you're a real estate professional. Commercial buildings have a depreciation schedule of 39 years, and it's 27.5 years for residential real estate, including apartment complexes. So what that really means, that depreciation schedule, is that you can take the price of a residential building, divide it by 27.5, and offset your income from the building by that much. Let's go through a realistic example from a single family rental that'll be pretty relatable, and I'm gonna use the lovely calculator.com for this. So I already filled this in for you so that we don't have to walk through all those steps. So we're gonna go with a purchase price of $350,000 and a down payment of 25%. That's needed in a lot of, these smaller real estate investment properties. So we'll go with an interest rate of 6.5%. That's about fair over a loan term of 30 years. So we have to add in the property taxes, of course, your insurance. We're not doing an HOA on this one. And the other thing that I'll say is this is assuming that you're managing it yourself. So I don't have a management fee on here. So we have a little vacancy rate on there to keep that realistic. We're going to up the rents by 3% annually, which is pretty typical. So we will talk about the sales part of it a little bit later, but for right now, what we're actually going to focus on is the cash flow part and the income part of it. So you can see that the rent is the income, and then you need to pay the mortgage, you need to factor in the vacancy part of it, and then you have the property tax, insurance, all that fun stuff that you can read here on the screen. And what it leaves you with is $347 of cash flow a month. And yes, you can run into issues that are pretty expensive, whether it's an AC repair or you need to replace a roof that you didn't know that you needed to replace. But this is just normal assumptions. So what you're left with here is a net operating income of $2,000 a month, roughly. So that is not taking into account what you need to pay for the principal and interest. So what we do is we take that year one net operating income that I said is a little over $24,000, and you take off the interest. That is not profit in the eyes of the government, and it makes a lot of sense. So you can take that as a deduction from your profit, and that leaves you with $7,104 of profit on this particular property in year one. So let's say out of the $350,000 that you paid for the property, $50,000 of it is the land and $300,000 of it is the building. The building is what you can depreciate. You can't depreciate the land. So when you put that $300,000 building on that 27.5 year depreciation schedule, you're left with a little less than $11,000 a year of depreciation that you can take on this property. So this is where it all comes together. You have an income of $7,104 for year one, but you can take depreciation of $10,909. So it actually leaves you with a negative $3,805. So what you can do is you take that net loss. So you're showing that you actually don't need to pay taxes on any of the $7,000 that you made this year. Plus, you can take that depreciation and carry it forward into the later years, because you're going to make more and more money as the rent grows, and more money is going to go toward the principal of the loan versus the interest of the loan. You'll be able to carry the depreciation into the future for those years, and it will help pay down as this becomes more profitable. You're still not really going to be paying much in taxes because of the depreciation. So now this is really where people make the money in real estate, even more than the initial cash flow when you buy this. There is great news here, and there's a little bit of bad news, we'll call it, but there's a way to get around it. This property is $350,000. Let's say you're holding it for 28 years. Just because the depreciation schedule is 27 and a half years. So we're gonna depreciate this thing all the way to 0. And the average growth rate is 3.5%. That's just normal, typical, what real estate does over the long haul. So what you can see here is the value of that property has now grown to $917,000. So this property that you initially put down less than $100,000 of your own money on has paid for itself, it's given you cash flow, and that cash flow, you haven't paid much in taxes on it, and now you have an asset worth almost $1 million. So this is a little bonus that I did not hint at, that is another trick that can be done here that's not really related to the tax part. And that is, you now have a $917,000 asset that you can borrow against. And you don't pay taxes when you borrow against a property. So if you did a refinance, you could pull out $600,000, $700,000 if you wanted to, and you can live on that. You can pay that back. You can do whatever you want with it, and you don't have to pay taxes on it. Now, the other piece that the wealthy use in spades is called a 1031 exchange. That's needed because you depreciated this property down to $0, and now it's worth $917,000. That means you have to pay capital gains taxes on $917,000 of gain. So now you can do a 1031 exchange, and I'm gonna let Fidelity tell us exactly what a 1031 exchange is. So the key takeaways: a 1031 exchange is a strategy that can allow real estate investors to defer capital gains taxes on sales of investment properties. To ensure that the exchange qualifies under Section 1031, you must follow a strict set of rules and work with an independent third party known as a qualified intermediary. So there are some rules when it comes to doing a 1031, but when you're talking about deals that are, $500,000, $1 million, $2 million, it's well worth going through the process to save all that tax expense. How a 1031 works is you sell your investment property, you transfer those funds to a qualified intermediary, and within 45 calendar days of the sale of the original property, you must identify potential replacement properties. So you can actually identify more than one property. As it says here from Fidelity, the IRS allows up to 3 properties to be identified regardless of value or more under certain valuation guidelines. You'll need to close on the purchase of 1 or more identified properties within 180 calendar days from the date of sale of the relinquished property. Okay, so what you do is you take that initial property, it's worth, almost $1 million. You've depreciated it to 0. But now instead of paying capital gains and buying something else, you can just roll this property right into the next property without having to pay any capital gains on it. Okay, so now you are super wealthy. You've rolled through a couple of these properties. You've been accumulating them through your whole lifetime, and you keep depreciating them down. Let's say you have a 0 cost basis on all these properties. Maybe it's worth $5 million now that you've been rolling property to property to property. So that means when your kids inherit this, they're now gonna have to pay a ton of taxes, right? Well, no, this is actually one final gift that the US tax code gives to the wealthy as they shuffle off this mortal coil. That $0 tax basis is actually stepped up to the fair market value of those properties on the day that the owner dies. So now the heirs can enjoy the cash flow from your real estate holdings and begin to reap the tax rewards through depreciating those properties all over again themselves. Real estate is a long-term game, Empires take a lot of time to build, but investing early and consistently allows you to leverage the US tax code to exchange up to bigger and better properties. I hope you found this topic interesting, and if you want me to make a video on depreciation through passive real estate investing where you don't have to be a landlord, leave me a comment. Please like and subscribe because it helps the channel immensely. Thanks for watching, and I hope to see you on the next one.